Now, when people used to buy homes with a 30-year mortgage, the reason that it made sense to buy a home, the reason that it was an investment, was because you paid off the house. After 30 years, you lived rent-free. Now you could retire. You'd burn your mortgage because you no longer had any debt. And the return on home ownership was that rent you paid to yourself and the fact that you're now out of debt. Well, today people aren't buying homes. They're renting them from the banks. They have interest-only loans, or worse yet, negative amortization loans, where they go deeper into debt every year. You know, all they're doing is hoping that the appreciation bails them out, that they build equity not by paying off the loan, but by the house just magically appreciating in value. That doesn't happen. I mean, it can happen for a short period of time, but it doesn't happen over the long run. Let me tell you a little bit about the subprime market, which I'm actively involved in shorting right now. But to show you what's going to happen, the way this subprime market works, and I didn't even realize this until I did the research to start shorting this stuff, but 65% of the subprime mortgage market, 65% of those bonds, of those mortgages where a guy stated income, no doc, negative am, risky loans, 65% of those things are repackaged by Wall Street and rated AAA. AAA. The equivalent of sovereign debt, of the best credit quality governments in the world. How can it possibly be that 65% of the subprime mortgages that are issued get a rating at AAA? How can that be? Well, the reason is Wall Street creates these tranches of CMOs, $1 billion worth of mortgages. And the way they structure it is they insulate the top 65% from losses by saying all the losses from interest and principal are going to go to these riskier tranches. The riskiest tranche, which represents 1% of the market, 10 million face, that risky tranche gets all the losses first. So that tranche has to be wiped out before any other tranche loses one dime of interest, let alone principal. Now, that particular piece of paper is rated BBB- and yields about 7.75% right now. That piece of paper should be rated F, and it will go to 0, as will several other tranches above it. Right now, one of the big trades that is starting on Wall Street, and which I'm participating in, is shorting that tranche. A lot of the brokerage firms now are creating derivative instruments where you can do these credit default swaps, and you can bet on those things defaulting. Now, what's going to happen as more and more people put this trade on, the price of those bonds is going to start to fall. As the price of those bonds, those risky tranche bonds, falls, the yields are going to shoot up. When that happens, it's going to make it impossible for Wall Street to collateralize this debt because it's going to be too expensive. Rates are going to rise, and the bottom is going to drop out of the subprime market. And of course, the subprime market is at the margin determining home prices. It's these buyers who are lying about their income, who are overstretching themselves, who are coming in here, and it's been made possible through this credit market where the buyers of these instruments are somehow believing they're insulated from losses, and people were willing to buy these risky tranches. Once they don't want to buy those tranches anymore, you're going to start to see a big drop or a big rise in interest rates, and that whole market is going to shut down. Because all of a sudden, when the mortgage people who are buying these bonds from you guys, when they can't resell them because Goldman Sachs and Morgan Stanley won't buy them anymore because they can't sell them, then it's over. There's no more market. There's no more secondary market for these products. And credit really starts to contract, and it's almost like a self-perpetuating spiral, because the minute you take away the credit and you make it harder for people to borrow money to buy property, well, you have fewer buyers. Of course, a lot of property is going to be coming on the market over the next year or two, because as I said, when these adjustable rate mortgages reset, a lot of people are going to be in a situation where they can't make these payments. Even if they cut back everywhere, they can't make these payments. And of course, a lot of them are going to be unemployed if they happen to work in the service sector and they've lost their jobs because other people have cut back. So a lot of properties are going to come on the market. If you think there's a high inventory now, wait a while. Who's going to buy these properties if there's no credit flowing? And besides, everybody already owns houses. I mean, we have home ownership right now is at an all-time record high. You know, there's never been more people that own homes. I mean, look at all the homes that are bought by single women in their 20s. You know, it used to be back in, I don't know, 10 years ago, 15 years ago, if two people got married, they were both renters. And they got married and they bought a house. Now two people get married, they're both homeowners. They got to sell one of them. You know, the whole dynamic. And one of the reasons this downturn is going to be particularly severe, right, when people are stretched to the limit on their mortgages and they have no savings. You know, back in the 1950s or 1960s, a guy lost his job. It wasn't a big crisis. You know, he had a stay-at-home wife. She can get a part-time job. He can get a part-time job. They had plenty of savings. They had a fixed-rate mortgage. I mean, it wasn't adjustable. They could get by. No big deal. It wasn't a crisis. Today, most people who have a home, you got two breadwinners. And even if one of them loses a job, they're done. They can't make the payments. The only reason they were able to do it before was because, okay, they borrowed some more money. They went to that ATM and extracted some equity. But all of a sudden, when you can't do that, you know, and a lot of the people who bought homes, you know, I used to laugh, all the people would be buying these adjustable rate mortgages. And they'd be asked in a survey, well, why are you buying an adjustable rate mortgage? Why don't you get a 30-year fixed? Well, I'm only going to live in a house for 2 or 3 years. Well, I would think, well, then why are they buying it? I mean, if you're going to live in a house for 2 or 3 years, just rent. Well, they were buying it because they were speculating. They said, I'm going to buy this house, it's going to go up, but I'm going to sell it in 3 years. Well, what happens when it doesn't go up? And what happens when the mortgage interest rate now resets and you can't afford it? Well, you just walk away. In fact, what a lot of people didn't realize, and I used to read a lot of articles about all the risks of nothing down mortgages and zero down mortgages. And I would say, yeah, you're right, there are a lot of risks, but the papers had it wrong. The risks weren't being borne by the borrower, they were being borne by the lender. That's the whole idea. When you put nothing down, you got nothing to lose. It's the lender that's taking all the risk. And of course, when you give somebody that situation, where you tell somebody, hey, you can buy this house for $500,000. You can lie about your income. You can put nothing down. And if it goes up, it's all yours. That $2 million bucks, yours. You can borrow it out tax-free every year, you know, it's all your money. And if it goes bad, just move out. You have nothing to lose, especially if they took a negative AM, teaser rate, adjustable rate mortgage, where for the first 2 or 3 years, the mortgage payment was really low. It might have even been lower than what they were paying in rent. And so they figured, what the hell? You know, in fact, for a while in California, it was much easier to buy a house than rent, because renters, the landlords were, they wanted you to prove your income. The lenders didn't need you to prove your income you can't have a stated income rent. They always do a credit check. They always check on your stuff. Landlords wanted first month. They wanted last month. They wanted a security deposit. Hell, you didn't need any of that to buy a house. You know, so I mean, a lot of people are just making this gamble because we put that in their minds. Of course, this is all going to unravel. This is all going to unravel. And as real estate prices start to fall, right, and you say, wait a minute, when they rose, look what's happened to real estate prices. I mean, what have they done? I mean, when people talk about, oh, we've created all this wealth, I mean, Barry mentioned all the wealth that we've created. We really haven't created wealth. What's happened is the value of our assets are now appraising at a higher price. But prices can change over time. The NASDAQ was 5,000, then it was 1,000. The stocks were still the same stocks. The perception of the value is all that changed. So the reason that real estate prices were so elevated was supply and demand, right? Everybody wanted to buy, and nobody wanted to sell. Why would you sell a house? It just kept going up. If you needed money, just borrow against it. And everybody wanted to buy because it was your ticket to Easy Street. If you were renting, you were an idiot. You were throwing away money. You got to buy. So everybody wanted to buy.